Nothando, I must say, it's the first time in a long time that I've had somebody who has exactly the same name as I do, just in a different language.
It's good to know. It's good to know.
Okay, welcome. Let's talk about the decision by Kenya's central bank yesterday, hiking interest rates effectively at 18%. It's good for the bond markets, but is it good for the system in general?
I think it's good for controlling inflation. Our view was that the moves we've seen in October, where we had the 400 basis point hike, and then the 550 that we saw in November, were probably sufficient, and that we were looking for them to actually have some time to see what impact that was having on inflation. But obviously the central bank decided that they want to take a very firm view on inflation and decided to hike further by 150. So they are taking a very firm stance against inflation. The flip side, of course, is that this is going to slow credit growth, which is not good for the banks.
Let's focus on that, because already with the recent interest rate hikes over the last 3 months, banks have started to really feel the pinch. We've seen the interbank rates rise. We're seeing borrowing costs rise as much as 25% to 30%. And as a result, many banks are having to reschedule their debt terms because they're just not going to be able to pay off some of those debts in the short term.
Yeah, I think that banks are trying to deal with a number of things. One is to say, okay, if I have an existing book, how do I ensure that clients are still able to afford their monthly installments? And if you're hiking their monthly installments or the interest rate from, let's say, 15 to 25%, that's a huge impact. So one of the things they are doing is extending the life of those loans and saying, okay, you will continue to pay the same amount, but instead of it being a 2-year loan, it's now a 2.5-year loan. But that's something you can only do for a short term. You can't keep extending the life of the loan indefinitely. The other thing that they're obviously going to have to grapple with is that some customers are just not going to be able to pay back. So I think the threat we have is that we're going to see non-performing loans rising, and banks are going to have to be better at collections and managing the book. The third part, of course, is what to do with their bond portfolios. It's good for the bond market, but they are going to have to take some mark-to-market losses on that unless these bonds are held to maturity.
A lot of these banks, as you're saying, are the largest institutional investors on bonds. They're also the largest component in terms of the forex trade in Kenya. And a lot of banks in their Q3 results recorded provisionings when it comes to forex losses. We're starting to see a stabilization of the shilling, but the damage is done, some would argue.
I mean, some of it is done. What we've seen over the last month is the banks offloading some of their forex holdings to take advantage of the strengthening in the Kenyan shilling. So no, the damage has been done, but I think what you're going to see now is a concentration as to say, well, where do we put the money? You know, we don't want to grow the loan book, so maybe we go into the short end of the treasury. But no, with treasuries offering 16.5% and lending rates sitting at 25%, it's pretty tricky.
Let's talk about how each bank fares, because there are different components of banks. The top tier banks, Equity Bank, KCB. Equity Bank, the largest bank by customer volumes. KCB, the largest bank in assets. They continue to be market darlings for capital inflows. How do they cope, given their size, with the changing conditions?
And I think this becomes a tough market for all the banks, regardless of size, regardless of strategy. As I said before, I think the focus becomes on who can manage the quality of their book going forward, because we are undoubtedly going to see credit growth slowing. That market has been seeing credit growing above 30%. In our view, that's going to come down to the low, 0 to 10%, if that. The focus has to be on who's going to manage the quality of their books. The advantage of the big banks is that they do have a big capital base. They can absorb more losses. We think the risk is likely to be with the second tier banks, where they're facing liquidity constraints already and are going to have to live with poor quality books.
That raises the question of cooperative bank, because they tend to be a lender to SMEs, and they also tend to be a lender to agro-processing businesses, which are the drivers of the Kenyan economy. What's their situation like?
Again, I think it comes to collection, managing your book. One thing on the SME side is it's a relationship management. So if you're close to your SMEs, you understand their business, and you can do things like extending the life of the loan, ensuring that the installment payments are affordable for the client. I think they may be able to manage that better. But still, it is a risk that we see. But the risk is also some of the corporates who are importing, for instance. The cost of things that they're importing has gone up. So the focus is not just on SME, but in saying, are some of the smaller corporates going to be in trouble? Are some of the bigger corporates going to be in trouble if they can't pass on these higher interest rates to the end customer?
What about the more international banks that focus on corporate lending? Barclays Bank, Kenya, Standard Chartered. We know that Standard Chartered has been on a very aggressive retail expansion drive, trying to grow its footprint in Kenya. What happens to some of those programs?
Again, when people talk about retail banking in Kenya, a lot of it tends to be for salaried employees. So, if they give you a loan, they deduct the interest payments directly from source, so before you even get your check. But again, the risk there is that people start to lose their job as the economy toughens up, and that then becomes a risk for them. I think the reason you sometimes see a flight to these international banks in terms of capital is because they're seen to have a big parent who can come in and buffer them should they need to be. But in terms of operating within the Kenyan market, it's tough for everyone.
Okay, I think you've been quite insightful. So I'll be Nothando for the day. You can be Lerato. Thanks so much for your time.
That sounds good to me.